Good afternoon, traders. Welcome to the live stream. My name is Charles Goff, and this is Pirate Traders, where we look at the market as an auction process. We're mainly focused on the ES and the NQ, that is the S&P 500 and the Nasdaq 100, and how they move through the two-way auction process. So if you look over here at our bookmap screen, you can see that everything just went completely dark. All the liquidity that there was in the market just completely disappeared. And that is because of the FOMC minutes. So the recording of the conversation that they had in the FOMC meeting has just been released, and the computers that can read that really, really fast and decide what they want to do are now entering their trades. And so this is going to remain relatively dark until that initial sort of reaction is going to happen. Generally speaking, when it comes to FOMC, what happens is we get a lot of fast moves right now at 2 o'clock. That will last about 10 minutes. If it's really dramatic, sometimes it can last 15 minutes. And then things kind of calm down and they cool off and they just kind of grind around until 2:30 when Chairman Powell comes out to speak. And then the party starts once again. It is worth noting, if you are going to take trades right now at this moment, the first initial impulse often gets completely retraced. So right now, that first impulse is to the downside. That tells me I don't want to be shorting the lows right now, because even if it keeps going, even if it's like pop, 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 and it keeps going lower, it will turn around and come back up. So if I were to hit the market sell button right now, I don't really know I'm going to get a chance. I don't know for sure it's going to keep going, or if right now at this moment is when it reverses and comes back up. So I tend to be very cautious and not really willing to enter trades right now in that, 2 to 210 time period, because that first move the market makes is often, almost always, a fake out. But once 2:30 comes and Chairman Powell is speaking, there's kind of one of two things. Well, we'll say one of three things that can happen. The first is the market could just do nothing. It could be a nothing burger and we just kind of slowly grind around while he's talking and there's just nothing special happening, in which case it's a bummer, man, because we like exciting FOMC days. They're just a lot more fun. So if it turns out to be a nothing burger, I'm going to be very disappointed. Okay, that's one option. The other option is the market could have a very large range, but constantly reverse itself. So it may go down 30 or 40 points, but then it comes back up 40 or 50 points. Then it comes back down and then it goes back up and it comes back down. This is a lot of fun, but you got to be very cautious trading it because you never know where those reversals will be. It has nothing to do with TA. It has nothing to do with like, oh, here's a resistance level. It's going to reverse right there. No. There's so many computers working at a very high frequency to take trades in a fraction of a second that those reversals can happen anywhere. And then door number 3, which is my favorite, is sometimes the market's kind of dancing around and then Powell starts talking and all of a sudden it picks a direction. Let's just say today we're to pick down and it just starts to pump. And then it will just keep going and going and going and going as long as he keeps speaking. And if he speaks for a full 2 hours, which sometimes he does, sometimes he doesn't, I'm talking about straight into the close. It will just keep moving and moving and moving in that direction. And it will blow your mind how far the market can go. 100 points is nothing on an FOMC day. Okay. So if that sort of scenario happens where once Powell is speaking, the market picks a direction and it starts to crank in that direction, that's where I start to look for trades. I call that trade setup the butt cheeks trade. There's a reason why I call it the butt cheeks trade, because the only way you can take it is not using a stop. If during that very fast, crazy movement, you try to enter an order and put a stop, I can tell you there's a 99.9% chance it's going to take out your stop. Okay. The range, the size of the range and the amount of volatility, they always come back for the stops. So if you're going to enter the trade, you kind of just got to get long or short and then squeeze your butt cheeks real hard and hope the trade is going to work in your favor. Let's say the market is pushing lower and you're like, all right, he's talking, it's pushing lower. It has momentum. I think it's going to keep going for a while longer. You get short. You squeeze your butt cheeks real hard. You pray to sweet baby Jesus that it works. And then as soon as it's in your favor, as soon as the market is moving in your direction, you go ahead and you move your stop above your entry. Sorry, you move your stop below your entry because this is a short in this case. And then you just trail your stop as the market continues to push lower, and eventually it comes back up and it takes out your stop. That is the butt cheeks trade. Now, I know what you're thinking, well, Charles, that sounds all well and good as long as I'm right and the market keeps going. But what if I get in the butt cheeks trade, I get short, and then it reverses on me? Well, that's what sucks about trading the FOMC. You would have to, at some point, just decide manually to exit your trade, which, of course, when the market is moving very far, very fast, is emotionally difficult. So if this is your first time trading the FOMC, please just log out of your broker account and log into your paper trading account. Okay. Even if the market is going to make a 100-point move, you don't need to be trading it with real money. Trade it in paper, practice doing this, get a feel for it, maybe do it over the next 5 or 6 FOMC meetings before you consider actually taking any risk with your real account. Because bottom line, you're gambling. Okay. All right. So we are 7 minutes into our first 10 minutes, and this is so far a nothing burger. Very little change, very little momentum. But that doesn't mean we won't get it when Papa Powell comes out. Papa Powell coming out. And of course, we will watch that video when he does here together. So the interest rate decision was 3.75, which is exactly what everybody expected. So these bots are starting to kind of read through the notes, and it's coming up with, important pieces of data like the Fed has uncertainty about the economic outlook. My favorite thing about Fed speak is they always say something bearish and then follow it up with something bullish 2 seconds later. Yeah, this really looks like kind of a nothing burger. I'm also going to be watching the trace chart. So this is Spot Gamma's trace chart. It's basically mapping out the options data based on the SPX. So right now we're looking at the delta pressure. That's what the colors that you're seeing on your screen are. Over here on the left side, these are basically the various different levels, the different strike prices on the SPX. And right now I'm looking at 0-day data, so we can also look at just all the data combined, but generally the most important is the 0-day TE because that has the strongest gamma, right? The biggest effect on the market. And so we're watching these strike prices and we're trying to figure out how do these change. Now, the nice thing is this only updates about once every 10 minutes, so we don't have to stare at it. We can just kind of check in on this, throughout the day. Right now, we're seeing that we have more, bigger nodes at those lower strike prices. So it's a little bit bearish to see. But if as, the next half an hour, if as these start to disappear, we start to grow strike prices above, that'll let us know we may be turning around to head back up. Also watching this hero line to see if it picks a direction. So far today, it has not because we've just been chopping around, but we'll be keeping an eye out for that as well. If you guys have any questions, let me know in the chat. If you are new to the stream, say hello. We'd love to get to know you. And if you have not yet, if you could just push that thumbs up button, it would really, really help out the channel. So that thumbs up is just basically your way of communicating with YouTube that you like what you're seeing. And so then YouTube goes, all right, well, if this person likes it, we should feed it to other people. So by pushing that like button, you're basically helping me send this video out to new people, which helps the community grow, which benefits everyone. So, why not give it a little thumbs up? Welcome to Jay. He says, let's do it. Jay Powell putting on his purple tie. Are we taking bets on the color of the tie? I am feeling very purple today. Tom says this should be interesting. Well, so far it's not, but let's give it some time. Crypto Rider in the house. Mark is here. He says dual mandate, blah, blah, blah. Oh yeah, we're going to hear all the stuff we've heard before. We're using all the tools. Will in the house. Paul is here. Griff. Griff says, how will Papa react? Well, we're just going to have to wait and see. I doubt he'll take any questions on anything political. He'll dodge those for sure. Willie T in the house. Ahoy to you. Trevor is here. Tom says, the only way I've found to be successful trading the FOMC is to trade very, very small. That is a great note. Yes. Size down. The way it works for me is like, it's like, this is the one day where I get to just have fun. That's the way I think about it. Like, this is not the day where I'm at work to make the money that I need to pay my bills. Today is the day to have a little bit of fun. I definitely don't want to lose a bunch of money just to have some fun. So I want to get out of those trades very quick if they're not working. Croco in the house. Candle Swinger is saying, do this. Thumb, 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 thumb. XU in the house. Hello to you. Silver Media. Welcome, welcome. Boy, Silver Media, you must have been busy lately. All right, so now that we are past 210, we have unfortunately reached the kind of boring stage where things are going to slow down and kind of probably go very little. We may come back down to the J low, but I don't think we're going to go much further until Powell comes out. So if you guys have anything you want to talk about, hit me up in the chat. If not, we'll just wait patiently together. If anybody's wondering what they're seeing on their screen right now, the screen on the left side, this is a market profile chart. So this is what's called a TPO chart. And basically what it's doing is each one of these letters is like a 30-minute candle, basically. And it's just splitting up the day into these 30-minute candles. And then we can look at it like a candlestick, expand it out to see how we've changed over a given amount of time. So far today, since the market opened, which is when the A period starts, this is the change the market has had. It's worked its way lower, making lower highs and lower lows right up until just now in the J period. And then we can also look at it collapse together. So this is that same profile right here that you see sort of to the left. And that is this exact same thing as this. It's just we've collapsed it on top of itself. So all the letters are smushing on top of each other. And the reason that we do that is that puts the information in a bell-shaped curve. The bell-shaped curve just makes it very simple for our human brains to be able to recognize the important areas on the chart. So if I were to, let's say I were to completely black out, give me 1 second here. Let's say I were to completely black this out. Okay. If this is all you're looking at, what do you mark as your important levels? You might say, ooh, okay, we got a couple of highs right here. That's probably important. We got a couple of lows here in the same place. That's kind of important, but it's hard to know exactly where things are happening. Whereas if I delete that and I can look at the collapsed profile, I can see the exact areas where we run out of steam to the downside and the exact areas where we run out of steam to the upside. So I can see support and resistance. So I can predict when the market comes back in there, that's where it's going to run into resistance. Excuse me. And not just from today, look at yesterday. That's where there was resistance yesterday. So by putting the market in a bell-shaped curve, I basically have an edge in being able to instantly visually recognize where are the areas on the chart where the market might find support or resistance. And that's important because maybe I want to go long or short there, or maybe I want to wait for that to break, right? Maybe I want to short the market right now, but I don't have the confidence it's going to go lower. So I'm looking at this area that was support and I'm saying, is that going to hold as support? Well, I don't want to short as long as it is. But as soon as we break through, now I can go short, right? Because now I know anyone who's been buying that support for the last couple of days, they're all about to get squeezed and the market is going to go lower. So knowing where those key levels are is really, really valuable in trading. If you're using candlesticks, you are seeing the market in two dimensions. All you are seeing is where price goes and how much total volume is brought in over that candle, right? So if it's a daily candle, just how much volume is brought in that day. If you're looking at a TPO chart, you can see exactly what level the market spent the most time, and you can see exactly where the market brought in the most volume. That's much more important than just knowing where did price go over a given amount of time. Because the more time price spends in an area, the more important that area becomes. The more volume the market brings in a certain level, the more important that level is. It doesn't matter how much volume the market brings in over the day or over the 30 minutes or over the 5 minutes, depending on what candles you're using. Who cares about that? What level is it doing it? That's what's helpful. And you need the volume profile for that. And then over here on the right side of the screen, this is the bookmap chart. So this is an order flow chart. This is software that basically shows us, if you look at this little white line that's running down the screen right here, everything to the right of that is the current order book. So these are the orders that are sitting in the order book waiting to get filled right now. And then if you look at the map over here on the left, you're seeing how those orders changed over time. And being able to observe what happens to price, which is like the little line, right? Being able to recognize what happens to price at the same time that you're seeing what happens with liquidity, you can start to make predictions about what the market is going to do next. Speaking of which, this looks like complete pinning to me right here. This is some serious bots holding us exactly where we are. The plunge protection team is in full force right now. Until Papa Powell comes out. 11 minutes. Auntie in the house. Candle Swinger says, sing some J-Lo. Why you gotta pick a female voice, man? You know I'm gonna break the microphone trying to hit them high notes. Don't be fooled by the rocks that I got. I'm still Charlie from the block. Used to have a little, now I have a little more. But no matter where I go, I know where it came from. Zoo's in the house. Welcome. Trevor says, what are your settings for the large numbers of contract sizes? What are my settings for the large number of contract sizes? Are you asking about on the stops and icebergs settings? So if you're looking at these numbers that are popping up here on the bookmap chart, oh man, sorry guys, I can't stop coughing for some reason. The ones that look like this, that have this little design right here, those are icebergs. So those are just basically larger orders that are being hidden as they're being filled. And then the ones that have the little circle, those are stops. And I can show you my settings. Okay, so this right here is my settings for those icebergs. You can see I have pretty high numbers here for my aggregate threshold. The reason that I have this like this is just because I don't want to see small stuff. I only want to see large players. So if it's more than 30 contracts, well, then that's somebody with some size, right? That's not Joe Schmo trading with 30 ES contracts. So those are my settings for the icebergs. And then I'll just quickly show you for the stops. It's the same idea. Again, we're looking at 50 plus contracts getting stopped out. That's what we're looking for, so that we know that these are large stops getting taken out. We don't want to pay attention to every Joe Schmo. Those are my settings for the stops right there. Screen grab now or forever hold your peace. User says, how do you get market profile? Well, this particular software that I'm using right here is called Window Trader. So you can just go to windowtrader.com and you can sign up to buy it. But if you are looking for a cheaper option, just search for TPO charts, and then whatever like broker you use or whatever trading platform that you use, most of them have some form of TPO charts nowadays. So it's not that hard to find a cheap or a free option. TradingView has a bunch. I will say when it comes to TradingView, they're like the actual TradingView TPO charts kind of suck, but there's a lot of plugins that you can get that are great. A lot of indicators that do it that are great. He's talking about the numbers on the volume profile. So how do I get them? I don't get them. That's just the market data. So each one of these, if you look at this, let me just zoom out for a second. Each one of these ranges that looks like it's kind of purple, that is a regular trading hours range. And each one that looks like it's kind of white and light blue, that is an overnight range. So the regular trading hours, I measure it as 9:30 a.m. to 4 p.m. And the overnight is 4 p.m. to 9:30 a.m. the next day. So when we look at the volume profile in there, that's the amount of volume that has traded at every level in that time period. So this one right here is showing us how much volume traded at these levels so far today during the regular trading hours. This one here is showing us within the last 30 minutes. Where was the volume? And this right here is the delta of the volume, but I don't use that. Six minutes to Papa Pal. Smash the like and be a pal. Otherwise, I'll stop right now. Yeah, man, this looks funny to me. This really is looking kind of pinned here. Anytime I start to see stuff like this, where you had levels, where there was a lot of liquidity, let me change colors here, where there was a lot of liquidity earlier, everything goes dark for the moment those minutes come out because who knows what's going to be in them, right? And then it comes right back at the same place. You know what that is? Bots. Suspicious. Zello says, what's up? What's up to you? How much volume does it take to turn a level pink or red? That is a great question. So it's not about a certain number. It's a percentage. So the white is the lowest 30% of volume. The pink is the middle 40% of volume. And the red is the highest 30% of volume. So why do we care about that? That helps us recognize what the market is doing. So for example, if we look at the current 30-minute profile, so this is just basically since 2 p.m. to now, what do we notice? Well, there's tons of volume in the middle and there's very little on the edges. So what has this market been doing for the last 30 minutes? It's just been balancing. It's just been going sideways, right? But if we look at the volume profile for the day, what do we notice? Well, we have some pink volume up here, okay, around the opening price. But where is most of the volume for the day today? It's down here. So what does that tell us? If most of the volume yesterday, let me just make this a little bigger, okay? If most of the volume yesterday was in here, we'll call that, 7,005 to 7,018, right? If that's where most of that volume was yesterday, but today most of that volume is below there, what does that tell us? We do not have as much momentum on the daily as we might think, right? This market has run out of steam. It needs to pull back in order to get people to go long, right? The market is always an auction process. It's like a store trying to sell inventory. Sometimes you're just so excited to buy this thing, you'll pay whatever it costs. That's what the market's been doing the last 2 days, right? The market broke out of balance 2 days ago and it pulled the volume higher. Look at where all the volume was. It was at the upper end of the range. So this was the market saying, listen, we'll keep buying this thing. We just want to own it. We don't care. We will chase price up. We'll pay the highest price we have to because we just want to have it. What did it do the next day? The same thing. They pushed that volume up much, much higher. So the market was saying, listen, we're not done yet. We're going to keep buying. You can just keep raising the price and we're just going to keep buying because we got to have it. So what did the market do? It pushed up again. Well, this time, instead of, we could have opened today and stayed up here and brought in volume, but that's not what we did. We turned around and we came back down and we brought in the volume down here. So that's the market saying, okay, this got too expensive. This got overpriced. No one was willing to pay this. So now we got to put the market on sale, right? We got to make the market a little cheaper. And so yesterday, this area right here was a fair price to do business. People were happy to do business there. Look, we spent hours right there doing business. But today we had to come a little bit lower. We had to make it a little bit cheaper to do business. So from here, what comes next? Well, either we bring in buyers down here. They do the shopping. They see the sale and they think it's a great price and they buy it, in which case we turn around and start heading up tomorrow. Or if they don't, what does the market need to do? It needs to come back down here to where we did business 2 days ago and see if people are willing to buy that price. If that's a discount that they're willing to buy the thing. And if not, we keep going. So being able to recognize those volume profiles and how they change, it's really important. The colors make it easy for the eyeball to see where is that intense levels of volume. Candle Swinger says, waiting on Mag 7 reporting. Yes, a lot of people are probably waiting on, there's a lot of earnings today, but that's not as big as the FOMC. The FOMC is definitely a more powerful, more potent thing. So Papa Powell should be coming out any minute now. Here he comes, you guys. It's really him. We should have done a survey about the purple tie. Well, we'll just have to see. As he starts to talk, I will go quiet and probably not be saying much. I'll be listening to him. But if something on the chart jumps out at me, I will turn on the mic and let you guys know what I'm seeing. And definitely if I think we're heading in one direction, I will say so.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized.
Okay, so obviously, so far, this is a nothing burger, and I feel like this is being mechanically pinned here. So what I'm waiting for are these levels right here around 69.70, 70-20 and 70-35. I want you to see those start to disappear and fade away. I think if they start to disappear, the market will start to pick a direction and make a move. If it's going to happen, it should happen soon. If, within the next 15 minutes, if we even start to pick a direction, then we're probably going nowhere the rest of the day. So hopefully, fingers crossed, they turn off this bracket bot and we get a break.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose in recent months. So we saw, data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas, but I'm not going to be getting into that.
Can you say whether?
Told you so. He ain't going to say nothing. No sound bites.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the U.S. currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So, I have nothing for you.
But, what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the Beige Book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting, we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer, thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rates, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. So you had a follow-up.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira. Thank you, Chair Powell. Mara Mokwe from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to employment have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the two goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, ex the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted, and I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot, really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between, to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So this isn't, I'm not talking about the U.S. context, this is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Thanks. Archie Hall from The Economist. On that sort of stabilization of the labor market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labor market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll jobs softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, your strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that? So
you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially the economy has once again surprised us with its strength, not for the first time. And consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from. But the economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative, and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control and, frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being a positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And, of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time is rising productivity. So and we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Thank you, Chair Powell. Bei from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, so no one thinks they will, ex ante understand really clearly, precisely when this will happen. But there's an expectation that sometime in the middle quarters of the year, we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period, and you can see for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether things are moving in that direction. I think we'll be able to see.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. Geopolitical risk for us is, a lot of it is around energy, oil. And so far we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but it depends on how fast potential output is growing, right? I'm just asked in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is, you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year. So the overall, over the year, the numbers were nothing like that. It was more in the mid-2s for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So there has been, you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed Chair. You've obviously experienced a lot during your time as Fed Chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Well, another is that, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
Hi, Nicole Goodkind, Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections, and that's the basis for how we think about the economy. So, and the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model. And we knew it from the very beginning. It was not in the model. A trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here and like maybe happening now with AI. We're all over that, and everyone studies those periods, and we're very clear-eyed about the possibility that this higher productivity may persist, and also that it may not. We're not. No one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time.
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything, and so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data, and our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
Okie dokie, there he goes. Did you guys notice that in his opening statement, he started saying good afternoon and then he cut himself off? What are they going to do if these, gambling markets, if they have a bet, will he say good afternoon or not? And he says good and then clears his throat. This is who wins? Tough to say. All right, guys. Well, I apologize for that being such a epically boring FOMC meeting. We've had a few of these. It used to be years ago. There was always a little bit of excitement, always a little bit of price action in an FOMC meeting. But over the last year and a half or so, we've had a few really boring ones, and this definitely counts. So, as I said, to me, the lack of movement is purely mechanical. If you paid attention to these nodes that we were talking about before the FOMC happened, they all stayed absolutely dead set. No liquidity was pulled at all. They just kind of sat there. And so there were no bots, that could react and try to make moves. I have a feeling they'll be gone by the close in about 45 minutes. But in between now and then, I don't think anything exciting is going to happen. So if you're done trading for the day, you're probably not going to miss much. But how do we carry this forward? What should we be thinking about tomorrow? It's a little bit tricky, okay, because there are sort of two different arguments that I can make for you. I can make an argument that we need to balance, and I can make an argument that we're going to keep heading up and making new, making new all-time highs. So it's all really going to depend on earnings this evening after market closes and how individual stocks react to those earnings calls. But let me give you some things to carry forward and think about for tomorrow. Talking about this purely from a technical standpoint. As we discussed earlier, value was lower, overlapping to lower today than yesterday. Okay? That's an important signal. Because when value becomes, when value is higher and then all of a sudden it becomes overlapping to lower, that's the market's way of telling you it needs to balance. That's the market's way of telling you it's probably done, at least for the moment, it's probably done with moving in whatever direction it's going to move. So for example, if you look at this day right here to this day right here, value is higher, but then on this day, value is overlapping to lower. So this market needed to balance. Now it did that with a liquidation break over the weekend that it then broke out of to the upside, which is a balance with price. Okay. Let me just zoom out here a little bit and try to find some other examples of this. So you can see here, value's higher, market goes higher, value's higher, market goes higher, value's higher, and then all of a sudden value's lower. Well, what was the market doing? It was going up. And then what did the market start doing? It started going sideways. Okay. So when you have that change in value, where value is moving in a certain direction and then suddenly something changes, that implies that whatever it was doing prior, it's probably done with. So the fact that we have lower value today, overlapping to lower than yesterday, is a little bit bearish to see. That being said, it's not like the market needs to go down, right? Because we still have higher highs and higher lows. So we're still trending on the daily. Our fairest price to do business barely changed. It did go lower, which again is less bullish, but it's not really bearish for the fair price to go down by like 5 points. So to me, I really see this, tomorrow, or I should say the next 2 days and into next week. I kind of see this more likely to dance around in here for a little bit, or to literally just start pumping higher again tomorrow. Now, of course, throw all that out if we get some crazy thing in an earnings call and a major stock starts to crash. But I don't really think this market needs a big pullback. I think it just needs to cool off for a little bit, and then we're going to continue the momentum to the upside. Also, this high, this overnight high, is extremely weak. Why do I say that? Why do I say it's weak? Because it was created outside of the regular trading hours. It was created out in the overnight. And if you look back at history, every single high that's been created in an overnight, the market has later come back and made a new high. Every all-time high that is created in an overnight, at some point, the regular trading hours comes back and creates another one. We don't actually have the old one. Oh, we do. So this one here, this was the previous all-time high. And so if you were watching the markets go lower and you were thinking, oh my God, the world's coming to an end, we're going to crash and burn, you would have wanted to be aware that we had that strong magnet at the all-time high, that at some point price had to come back to that all-time high. And so it shouldn't have been such a shock when the momentum shifted and we came back up. Now we passed through that last night. Okay. But that's still overnight traders. The regular trading hours has not had a chance to poke up here and sweep the order books. So there's people that shorted in here that haven't been swept yet. There's people that shorted in here last night that haven't been swept yet. They've got their stops up there at the all-time high. So to me, that is a very strong magnet that the market during the regular trading hours in the days ahead is likely to poke up and make that new all-time high. Okay. With that, I will say goodbye. I wish you guys the very best. If you are not a member of the Pirate Traders Brigade, there's a link in the description you can join. Also, if you're newer to trading and you really want to take your trading to the next level, you're thinking, I want to go pro. If you head to piratetraders.io, which is the website, and you scroll on down, going downtown, you'll see this right here. About this workshop, Mastery of Markets and Minds. Okay. This is a workshop that I teach a couple of times a year. I don't do it often. And in this workshop, I basically teach everything you need to know to be a professional day trader. Okay. So I am teaching you how to manage risk. I'm teaching you how to enter trades. I'm teaching you how to, read the chart. I'm teaching you all of the processes that you need to know in order to be successful as a trader. There's a reason why I say it's the air quotes, the last trading course you'll ever need to take, because it gives you all the tools you need so that after the course is over, all you need is screen time. All you need is practice. Okay, so if that is something that you might be interested in, I encourage you to sign up for the Mastery of Markets and Minds workshop. You could also just head to marketsandmind.com if you wanted to learn a lot more about it. And you can kind of see, one by one, each of the lessons. What is it about? You can read, opinions of previous people that have taken the course. You can scroll down here and you can see each lesson, what it's teaching and why that might be valuable to you in your trading. So I know $500 is a lot of money for some people to spend on education. I understand that, but it's well worth it. You'll make $500 in a day when you're a good trader. And this course will give you the skill set to do that. So I highly recommend, if you are new, join the brigade. If you've been in the brigade and you're thinking about you want to take this more seriously, consider investing in this course. It's just a couple of weeks away, and I don't know when I'll do it again. Probably not until the summertime. So if you are interested, we'd love to have you. Thanks a lot, everyone. Members of the brigade, we will see you tomorrow morning.